Welcome to Spring into ETF Investing. On today's special episode, our panel of guest speakers will be discussing ETFs as a stock replacement tool and sectors to watch in 2024.
This is ETF Market Insights, and I'm Erin Allen, VP of Online Distribution with BMO ETFs. Welcome to the channel. For those who are new to our channel, our goal is to provide timely market-related insights and ETF-focused education to Canadian do-it-yourself investors, with the goal to become your trusted partner in investing. We want to bring you access to the same level of high-quality resources that advisors and institutions receive in our industry. Before we begin, a quick reminder that today we are not providing you investment advice or recommendations. Our channel is all about providing education around investing and around ETFs. Today, I'll be passing off my hosting duties to Nate Kennedy. Nate is the host of the New Money Nate podcast, where he chats about all things money and is a content creator with close to 1 million TikTok followers, where he delivers a mix of personal finance education and motivational coaching to his followers. Thanks for joining us, Nate. Take it away.
Welcome to our interview where we dive into the dynamic world of exchange-traded funds, ETFs, and their pivotal role in redefining investment strategies. Throughout our discussion, we will explore how ETFs serve as an effective alternative to individual stocks, offering diversification and risk mitigation. Additionally, we'll dissect the mechanics of ETF trading and some tools investors can leverage to improve their portfolios. First, I want to introduce my lovely panelists. First, we have the lovely Danielle Nezel, Online Distribution VP with BMO ETFs. Danielle, thank you so much for being here. I'm also joined by Tony Dong, journalist and ETF analyst with many publications you definitely recognize, like The Motley Fool and SIBO ETF Markets here in Canada. Danielle, we've seen tremendous growth in the adoption of ETFs with DIY investors. How do ETFs serve as an effective replacement for individual stocks in an investment portfolio?
Great question. And thanks for having me back on the channel. It's really great to be back talking about ETFs. So ETFs have really boomed in Canada. We're looking at over $400 billion in assets that Canadians have put into ETFs.
400 billion.
400 billion, a little more than that actually. So Canadians are looking to ETFs for all of their benefits. A lot of benefits that ETFs have over stocks have something to do with risk mitigation when Canadians are managing portfolios and Canadians looking to ETFs to help with managing risk in their portfolios. So we always need to remember, and I talk about this a lot, when we're managing our investments, we're managing return. Yes, we think about that a lot, but we're also managing risk. And you need to think about both sides of the equation to successfully manage your own portfolio. So with ETFs, right off the top, one of the greatest benefits is diversification. And this helps with risk management because instead of having one or two or three stocks, now you have a portfolio of stocks. You have sometimes 100 or even 1,000 different holdings within a single ETF. So this already takes a lot of risk off the table by kind of smoothing out returns, looking at being invested in a broad market or a lot more investments versus one or two different stocks.
Yeah. And I think it's really interesting. You know, there's so many companies in some of the ETFs you don't even know, but it's ETFs have this great thing where they're self-cleansing, where, you know, ZSP, for example, you know, bottom three get booted out if they don't have the earnings and they can't make it, and the next three come out. So they have this self-cleansing sort of tool. Tony, what are your thoughts on risk mitigation when it comes to ETFs, and how do you personally think that like it's a great tool versus individual stock?
Great question. So there's a very good study out there that has this really cool graph that shows how your level of risk steadily falls off as the number of equities you hold increases. And the magic number is around 30 or more. Of course, it depends on the segment of the market. For example, if you're dabbling in small caps, you're going to need a lot more stocks. But the takeaway from that is for individual investors, managing 30 or so odd positions is very hard, right? Even with transaction-free brokerages, you need to think of the bid-ask spread. You need to think about rebalancing 30 positions on your own. It's a lot of work.
So much work.
But when you have a universe of hundreds of ETFs with that 400 billion in assets under management, there's going to be an ETF out there that corresponds to the exact strategy you want, whether it's based on a pre-existing index, whether the fund manager implements their own special rules, or if it's actively managed, you have a professional active manager overseeing it. There's going to be an ETF for you out there.
So what are your guys' thoughts on multiple ETFs with risk mitigation? You know, you'd imagine, let's say one ETF could, as we said, have thousands of different companies within it. So, is it a prudent thing for an investor to have multiple ETFs in their strategy? Or, there are some all-in-one products that are out there, of course. So what are your guys' thoughts on that sort of strategy?
Yeah, maybe I'll jump in there. So I think an investor first needs to determine what is their goal for their investment portfolio. What's their time horizon? There's a couple questions they need to ask themselves. And then they can look at finding several different ETFs that work for them. As you mentioned, there is asset allocation ETFs. So if there's an investor that kind of wants to set it and forget it and make a single trade every year and be invested in the total market with equities and fixed income, there's products out there for them. And you can have a full total exposure to the market using a single ETF, which takes away from those transaction fees and the rebalancing that you were talking about, Tony. But then there's some other investors that think maybe a couple ETFs work for them. Perhaps they want to get invested in a dividend strategy or a low volatility strategy to tweak their portfolio in a certain direction. We kind of talk about core and satellite positions. So maybe holding a couple broad market equity ETFs as a core position, and then tweaking towards an income strategy, for example, with a covered call ETF or a dividend ETF, or tweaking towards maybe a little more growth with a thematic ETF. So an investor kind of has to set out, what's their goals for that portfolio and those investments. But a couple different ETFs can absolutely work, or a single ETF as well.
Absolutely, yeah. So can you actually walk us through the mechanisms of how an ETF trades and how they might differ from an individual stock and mutual funds? Because I'd imagine, mutual funds, it's standard one price closes, it's not trading. So but like in particular with a stock versus an ETF, are there similar, like are they exactly trade the same, or are they different? Like, I'd love for you to walk us through that.
Sure. So we say the similarities are that an ETF and an equity, both you can buy them and sell them on the exchange during market hours. So that's the similarity. Where there's some differences, and this is actually a benefit for ETF investors, is with an ETF, you actually get more liquidity, or another layer of liquidity, than you do with stocks. So a stock is issued by a company. There's a finite amount of units or shares that are issued, and those are traded throughout the day between buyers and sellers, and they can connect on the exchange to buy and sell that investment. With an ETF, we have certainly that level of liquidity as well. So you and I can say, I would like to sell a share of ZSP. You might be on the other side of that transaction, and we can buy and sell that ETF. We also use market makers in the ETF world. So a market maker is a dealer, and they hold an inventory of ETFs. So quite often, you are meeting a market maker at the other side of the transaction. You don't know when you're on your online brokerage and you're making a trade, but market makers hold an inventory of ETFs, and they help with that extra liquidity. So I use a car dealership as an example. Often you can sell your car or buy a car at a car dealership. You don't know who the end user is going to be if you're selling your car, but that dealer facilitates the transaction for you. The third layer of liquidity is unique to ETFs, and stocks don't have this. And this is a layer that a lot of investors aren't aware of, or they don't think about. And this is called the creation redemption mechanism. And it's important to understand because we get a lot of questions about volume on ETFs. People come up to me and they say, Danielle, I wanted to buy this ETF, but I looked in the volume, there's not a lot of volume on it, so I'm concerned. But in fact, what they're missing out on is the liquidity that the underlying holdings actually have. So if you want to, the creation of an ETF is when we make more units of that ETF. So if there's a lot of demand, and our portfolio managers will actually buy all the underlying stocks within that ETF and then deliver that ETF to the investor. Conversely, if they want to redeem an ETF, they basically dismantle the ETF and sell all the underlying shares and then provide cash to the investor. Right. So that's the creation redemption, is that third layer of liquidity investors sometimes aren't aware of or don't totally understand. And that creates extra liquidity for the end investor. So another huge benefit for ETFs.
Tony, let me ask you, liquidity, I'd imagine for institutional traders is a very, very important thing. What are your opinions when it comes to do-it-yourself investors? A lot of the major ETFs have enough liquidity to get a pretty good price on it. You're buying maybe once a month or something like that. So what are your thoughts on liquidity when it comes to do-it-yourself investors? Is that something that should be at like the top of their priority list, or is it just a consideration that they should have?
I think liquidity should be factored into your total cost of ownership if you're a DIY investor, especially if you're trading a lot. So when you think about something like ZSP, it's very liquid because the underlying S&P 500 index and the stocks it holds, which are 500 large and mid-cap US stocks, are very liquid. So trading this ETF, you incur a very minimal bid-ask spread, which is the difference between the buy price and the sell price, right?
Yeah.
Now, if your ETF is tracking some more illiquid assets, for instance, if it holds some weird corporate bonds or emerging market bonds from a country across the world, that may not be as liquid, and that will incur a larger bid-ask spread. For a buy and hold investor, this consideration isn't as important, but if you're going to remain in your position for only a short amount of time, that difference between the bid and the ask should be added to your total cost of ownership, right? Because you're incurring a cost to jump in that position and out of that position. So once again, to reiterate what Danielle said, it goes back to your objectives. If you're a long-term buy and hold investor, it may be okay to, accept an ETF with a wider bid-ask spread if that's the strategy you're looking for. But if you want something liquid, something that tracks a major index, and you're not planning to stay in that position for a long time, absolutely look at the bid-ask spread and make sure that the underlying assets in the ETF are liquid. Generally, if you stick to large cap Canadian and US market indices, that shouldn't be a problem.
You should be okay, but it's a huge consideration.
Absolutely, watch out for it, and be careful if you're trading around market open or market close or during extreme times of market volatility, because the creation redemption mechanism is really good, but it can suffer dislocations. There was an instance during the 2020 COVID-19 pandemic where a lot of bond ETFs, where the underlying bonds are traded over the counter. When that credit crunch happened in March 2020, a lot of these ETFs, their net asset value their price actually fell below the net asset value because that creation redemption mechanism wasn't able to keep up during times of market stress.
Right.
But this is very rare, but it can happen. So as always, when you're making these investments, make sure you do your due diligence and practice good risk management, right? Size your position properly, use limit orders, and be patient.
Tony, we're going to stick with you. So we've talked about replacing individual stocks in your portfolio with ETFs to increase diversification. But what about the whole thing, the entire portfolio? What is available from BMO when it comes to a tool that can provide an all-in-one solution for investors?
So that's totally viable too. I think there's two types of DIY investors. You have the slice and dicers, which like to cobble together different stocks and ETFs. And then you have the couch potatoes. I think you said you're a couch potato.
I'm a couch potato.
A lot of people are couch potatoes. And it's a good thing because, I've heard this saying, your investment portfolio is like a bar of soap. The more you touch it, the smaller it gets, right? Yes. Sometimes it falls out of your hand and goes down the drain completely. But if
hopefully not.
Hopefully not. But the all-in-one asset allocation ETFs make it a lot easier to be a couch potato. And the whole guiding principle behind this is that different asset classes, different stocks at different geographies and sectors, different bonds at different maturities, issuers like government versus companies, will behave as a whole better than the sum of their parts. So individually, these assets may be quite volatile, but because they're not all perfectly correlated, some of them zig while some of them zag, when you combine them in different proportions, you can actually maintain a target level of return without sacrificing too much risk. Right? So you're finding the optimal blend of risk and return. So from BMO, there's a set of multiple ETFs corresponding to different time horizons and risk tolerances. For example, my favorite one is ZEQT. So this is a 100% equity solution. It's all stocks, no bonds, but it's globally diversified. So you have the usual allocation to the US stock market, given how big it is, but you also have what is called a Canadian home country bias. So there's an overweight to Canadian stocks relative to what their size is in the global market. And the reason for that is historically, it's proven to lower volatility, improve tax efficiency, and reduce currency risk. But that's not where it ends. You also have international developed markets like France, Germany, the UK, and you have emerging markets like India, China. So really, you're holding thousands of stocks from around the world in one single ticker, and I think that's pretty cool. But maybe 100% stocks isn't your jazz, right? Think about this period of time. It's called a lost decade. You go back to 1999 to 2009 in the US. US stocks were completely flat. I think like 1.7 annualized returns. That's a decade of seeing stagnation. But bonds during that time returned much, much more. And I know we're all subject to recency bias. And in 2022, we saw bonds fall as hard as stocks did, and that might have spooked some investors. But there's ample historical evidence that suggests that a lot of people tend to overestimate their risk tolerance during the good times and forget about the impact of bonds.
Tony, when we think about diversification, is it kind of similar to like taking your veggies? Like, you should be doing it, but like you've got the US market, you've got Canada. I find that, a lot of investors, when they talk about their portfolios, they have a huge home bias, right? You have S&P 500, maybe a bit of bonds, and a lot of people are like, okay, well, why do I need anything else? And of course, the Magnificent Seven are global companies, but I guess how do you think DIY investors should be thinking about international markets, emerging markets with a prudent investment strategy?
I don't think it's like eating your vegetables at all. I think it's more like being offered a free dessert and turning it down because you don't want to try it out, right? Maybe there was an argument 20 years ago where indexing international markets was quite expensive, but now it's very cheap. For instance, the BMO asset allocation ETFs include that developed market and emerging markets all in one for a very low fee. And the other part to note is that by excluding international markets, you are importantly leaving out around 30 to 40% of the global market by market cap. You're leaving out amazing companies like Taiwan Semiconductor Manufacturing, ASML Holdings, two very big chip makers. You're leaving out Toyota, you're leaving out Nestle, you're leaving out Unilever, Shell, BP. I can go on and on and on, right? There is no evidence to suggest that the US markets will outperform perpetually. Similarly for Canada, when you can get thousands of stocks from around the world in a turnkey solution for that cheap, I think it'd be very, very irresponsible to pass it up. Of course, if you really believe in a country and that's what you can stick to, there's nothing to say that you can't do that. But when you're giving me that for that cheap, I'm not going to turn it down personally.
Yeah, that makes sense. Danielle, what about harder to access stocks and asset classes? Give us some examples of ways ETFs can be used to give us access to some of the hard to reach areas of the market.
Yeah, absolutely. So ETFs have really opened up the market to investors, especially do-it-yourself investors, for these asset classes that are a lot harder to access or that historically only institutional investors could access. The first example, which I think is the best one, is fixed income. So prior to ETFs, I don't really know how a do-it-yourself investor would be buying and selling bonds. So the bonds don't trade.
It's hard.
Exactly. So they don't trade on a stock market like equities do. You have to go through bond dealer. Bonds are already illiquid by nature. You would have to find out a price for them because there's no price transparency since there's no open market. So getting fixed income into a portfolio would have been very, very hard. Enter ETFs. They have taken care of this for investors. So now investors can trade fixed income just how they can trade equities. And they can see intraday pricing on fixed income. So that's been a huge thing. And Tony, you mentioned during the early days of the pandemic, when the fixed income market completely froze up. So the bond market froze. Fixed income ETFs were actually still trading. So mind you, with a very, very wide bid-ask spread because of the market turmoil and uncertainty, but investors could still get in and out of fixed income, which is a remarkable thing when you think about a bond market being completely frozen. So there's a great benefit there how ETFs have opened up the fixed income market. And then there's other harder to access asset classes. So we talked about emerging markets. To buy and sell for example, Taiwan Semiconductor, which trades on the Taiwanese stock exchange, this would be almost impossible for a Canadian investor to do. First of all, the stock exchange in Taiwan would be in the middle of the night for a Canadian investor. So things like that, it's so much easier to get access to companies like this with an ETF that's trading on a Canadian exchange in Canadian hours. And then we think about asset classes like gold. So for example, BMO just listed ZGLD, which is a gold bullion ETF. So you can actually buy physical gold using an ETF instead of going to a bank and buying your gold bullion and finding somewhere to store it, paying those storage costs. There's a lot of hurdles involved in a transaction like that. Now you can do it sitting on your couch and watching Netflix. Crypto assets are another great example. You don't have to open up a digital wallet if you wanted access to crypto in your portfolio, but didn't want to go through those added steps. You can access that as well with an ETF. So ETFs really just opening up so many hard to access markets and making them really easy for Canadian investors to add to a portfolio.
Tony, we've talked mostly about equities, but let's look at bonds. We did talk a little bit about bonds, but I'm always surprised that there are still investors out there investing in individual bonds. So, similar to what Danielle said, how have ETFs really innovated the fixed income space and allowed for easier access to the market?
Absolutely. So picture this. You're a retail investor. You're trying to buy a bond. You're going to be going up against a Bay or a Wall Street bond desk. These are people who've been doing this professionally for years. They're armed with a Bloomberg terminal. You maybe have Wealthsimple open on a phone or something. Imagine trying to trade bonds there. And like Danielle said, there's no centralized pricing. So you need to figure out the yield to maturity, the duration, the average credit quality, all these different factors that are really hard for the average person to calculate. But if I was to buy a BMO bond ETF like ZAG, I can just go on the webpage. I can look up what the yield to maturity is, which is the total return expected if all of the individual bonds within were held until maturity. I can look at the duration, which governs how sensitive it is to interest rate changes. I can even open up the portfolio composition file and see all the individual bonds that ZAG holds, what their maturity is, what their coupon is, who they're issued by. Is it the government of Canada? Is it another bank or something? And most importantly, I can trade it just like a stock with a bid and ask. I can put in a limit order, I can watch that fill, and that also makes it really easy to rebalance. Because when you think about an individual bond, right, you can't really sell out of that. You're gonna get eaten alive on the bid, you're gonna get eaten alive on the ask, and the coupons usually pay semi-annually. If I'm relying on my bond for income, I don't want to just get 2 payments a year. I want one every month.
Yeah.
But bond ETFs, they smooth out that income distribution. You get a distribution usually every single month. So if you're an income investor wanting some lower risk income, the bonds are a great way to do that. And also, accessibility is a thing. So when you think about bonds, most people think aggregate bonds. So you have your government bonds, your investment grade corporates. But what if I want access to the high yield market? What if I want access to emerging market bonds like an Argentinian government bond? Where am I going to find that? Individually, that's a nightmare. But BMO has ETFs that correspond to both of these. There's one for junk bonds or high yield bonds. There's one for emerging market bonds. You have floating rate bonds. Essentially, if you're a fixed income enthusiast, you can find a bond ETF that gives you all the exposure you want, but with the liquidity and convenience of a stock. And personally, I'm a bit of a fixed income nerd. I love these products.
Yeah. It seems like there's pretty much, it's like a buffet almost. There's you want short duration, long duration, international, here in Canada, you can have at it. So some investors adopt a particular strategy. Maybe they're dividend investors or, they like income like we're talking about. How have ETFs redefined how investors can access some of these different strategies?
So let's say I was trying to make my own dividend portfolio, right? And I wanted monthly dividends. I would literally have to pick a bunch of different dividend stocks, make sure that the ex-dividend dates all occurred on different dates to get that staggered income. But with a BMO dividend ETF like ZDY or ZDV, I get that monthly distribution. I get a portfolio of stocks that are screened according to fundamental metrics on their dividend health, dividend sustainability, dividend yield that's rebalanced on my behalf, and I get that income. So it's not like very chunky and so forth, right? But if I want more enhanced income, I could write options on my own. But to write an option, I have to own 100 shares of the underlying.
Yeah.
And then again, I have to manage a bunch of different positions.
A lot of work.
Yeah, I got to choose which strikes to write. I got to choose how far out I set the expiry date to. If my call is about to get assigned, do I roll out? Do I roll up? Or I could pay some basis points and leave that to a professional options trader who does it on my behalf and delivers that distribution package to me every single month. That's what the covered call ETFs do. So,
right.
If you like managing that, you can. I personally don't, and I do this for a living. So that's why I like using the income ETFs.
Yeah, and that makes total sense. I think it reduces a lot of work, and you're ultimately going to get the same, if not better, results. So it's quite a good look there. Danielle, we've talked about adding ETFs to a portfolio to replace stocks, but can you also use them to complement an existing stock portfolio if you're not looking to sell your stocks? Just walk us through a couple complementary strategies that can be used.
Absolutely. So we're seeing a lot of investors use this hybrid approach, ETFs and stocks in their portfolio. Again, going back to that core satellite type of investment construction or portfolio construction has been pretty popular amongst Canadian investors. So that's when the core of the portfolio, they use an ETF for the core. So something like a broad market ETF, like a ZSP to access US equities, or a ZCN to access Canadian equities, or even an asset allocation ETF. And then their satellite exposure, so this is the smaller exposures around the largest part of the portfolio, they use stocks. And this might be just a personal preference, and investors would like to make a couple bets in the stock market to tilt their portfolio to more of a growth scenario. Or a lot of investors receive stock options at work, and so they have a lot of stock from their employer, and so they're using ETFs to kind of diversify away from those exposures.
Yeah, it could be, if you're working somewhere, that's how you earn your income, that's how you do everything, and so ETFs can serve as is a great way to basically not have all your eggs in sort of one basket.
Absolutely.
Yeah. So Danielle, are there tools BMO or another tool providers can offer that can help investors find a replacement for stocks in their portfolio?
Yeah, so we actually built out some tool capabilities for investors. They're free to access at BMOETFs.com.
Really?
We have several different ones, but one specifically when we're looking at stocks and ETFs. So it's our ETF screener tool, or sometimes we call it our stock replacement tool. So this is for an investor that wants exposure to a specific stock, but would like to get that exposure within an ETF. So for example, if an investor, say they would like exposure to Tesla, but don't want to own Tesla outright, they can type in the ticker for Tesla and they can find out which ETFs are listed in Canada that have the largest exposure to that company. And so this way, an investor can add an ETF to their portfolio, still access that diversification, a basket of equities, but tilt towards a specific stock. Conversely, if there's a stock you do not want in your portfolio for maybe there's an ESG reason, or maybe it is a company you work for, so you're already overweighted that company, you can search that stock and you can screen and you can look for all the ETFs that don't hold that stock. So we're finding investors are really using this tool to help them see, look under the hood, as we say in their ETFs, and really see what they're holding and then tweak exposures that way.
Yeah, and I do think it's really important to have, because there's a lot of ethical investors that are out there. They, like you said, they might not want big oil in their portfolio or something like that. So it's wonderful that you guys are, able to help, investors filter for that. But I think that covers off our discussion today. So thank you guys so much for coming and bringing such great insights to today's session around ETFs and how they offer a power alternative to individual stocks. And yeah, thank you to BMO ETFs for continuing to host these educational segments for DIY investors. And guys, thank you so much. Have a wonderful day.
And now I'm going to turn over my hosting duties to Sejal Patel, host of the Strictly Money podcast and YouTube channel, where she helps Canadians master their personal finances. Sejal is a financial analyst, award-winning business TV journalist with CNBC and BNN previously, and a publicist with more than 20 years of experience in the financial industry. We're excited to have her host today's session. Sejal, over to you.
Welcome to our discussion today, where I am joined by some of our industry professionals to discuss what sectors to watch in 2024. With tech and the Magnificent Seven leading the change, we'll explore what's driving their growth, geopolitical risks, interest rate environments, and much more. With me today, I have Chris McKinney. He's a portfolio manager with BMO ETFs, and Valerie Grimba, who is a market maker at RBC Capital Markets. So welcome both.
Thank you.
Happy to be here.
So Chris, let's start with you and ETF fund flows. I think we can both agree that the sector that got the most love was technology. Can you talk a little bit about what was driving the dominance there?
Sure, and you're right. Technology is the sector that's been getting the most investor love, so to speak, so far this year. If we look at flows in the US industries, so year to date to the end of April, technology sector ETFs have brought in $11 billion. And there's really no other sector that's close to that in terms of the magnitude of flows coming in. We see on the top, other than tech, there's been financials and energy getting a little bit of flows more in recent months. So that's an interesting phenomenon there. A little bit cyclical sectors getting some flows, but again, nothing really matches what's been going into technology right now. As for the factors that are driving that, you really have this continued momentum around this AI movement. And it's not from the technology companies themselves, but we have a few quarters now of other CEOs in other industries talking about AI, how they're using it in their business and how they're going to deploy it to either gain efficiencies or add value in some other way. And so when you have companies in the financial industry, communications, consumer stocks, all talking about this adoption, it's a real big build out. And the beneficiaries, of course, are those technology companies, whether it's the chips to run AI models, whether it's someone running an AI model themselves, or all the other infrastructure that goes into that. All roads lead back to those technology stocks. And so that's been a really big boon for them so far here this year. Also, we have the continued resilience of the US economy in general. We went into the year thinking there might be a recession, several rate cuts potentially because of that, and we've seen economic growth continue. And I think that just boosts investor confidence in general. And technology as the sort of risk-on sector tends to be the beneficiary of that.
Valerie, let's talk about the Magnificent Seven, which when I look at it, it's actually contributed about half of the S&P index's returns. How are those stocks influencing the market dynamics?
Yes, listen, the Magnificent Seven have been such a powerful momentum force within this market for the past 18 months. No doubt they have been the key drivers of a lot of US equity performance. And the reality is that to a certain extent, they're here to stay. The S&P 500 is as concentrated as it has been in the past decade right now. The top 10 stocks account for nearly 35% of the S&P 500. So no doubt kind of where those stocks go, probably the broader market will go as well. Magnificent Seven year to date, yes, they've been big contributors, but when you drill down into it, it's really about the Magnificent One, that stock being NVIDIA. It's up 90% year to date, and it has been a big driver of kind of the overall performance. And that again is to what Chris was talking to, is this AI secular growth trend. They've been a big beneficiary of that. The numbers have backed up the growth story, and investors have rewarded the company accordingly. Now, we have seen kind of valuations go up as these companies have grown larger. And some might say that right now they might be priced to perfection, or they need to keep delivering on strong growth to kind of see valuations or stock prices rally from here. You might want to consider looking forward as well. There might be a future where we see kind of a rate cutting cycle come into play, which I think we'll discuss further, but it could cause some kind of market rotation there as well. And you might see some of the other areas of the stock market that have been lagging sort of take a leadership role here. So I think there's a lot of interesting dynamics at play, and you probably ideally want to have exposures to both ends of that story.
Yeah, let's talk about that, Chris, because there are some headwinds in the tech sector. There's certainly some regulatory scrutiny, especially when it comes to AI, privacy concerns, as Valerie mentioned, valuation concerns. And at the same time, you're seeing some market volatility because people are questioning the timing of the interest rate cuts. So for investors who want to see growth in their portfolio, but they still have to navigate the market volatility, what do you suggest? What sort of strategies can they use?
Yeah, there's a few things investors can look at, and your point is well taken that particularly recently, we've seen a little bit of moderation from the technology sector in terms of their performance. Certainly it has been strong, but in the last month or two, we've seen a little bit of softening there. If we look at the most recent earnings cycle, companies like Meta Platforms / Facebook delivering pretty negative earnings, whereas Google or Alphabet in the same space, same subsector, very positive earnings. And so even within a sector, you can see this differentiation between companies. And so, just using sector ETFs in general, I think speaks to a great way for investors to tackle that diversification element that everyone knows about ETFs provide, even within a narrow sector. Utilizing a sector ETF rather than trying to pick one or two companies helps to reduce that overall volatility. One other thing investors could look at, especially if you're thinking about a potential moderation of growth going forward, is to utilize an ETF that provides a covered call overlay. And for investors in Canada, there are lots of covered call strategies on sector-specific underlying portfolios, and technology is one of those where you can get a nice income stream on top of the growth potential that technology companies provide. And that allows you to reduce volatility within the portfolio a little bit as well. So that's a couple of strategies investors could look at. And of course, the other, if we're talking about technology, you've probably had a pretty good run, pretty good returns from that sector. Maybe you can take a little bit off the table there and rotate into another sector. I mentioned energy and financials getting some interest and flows recently. Those sectors really have different drivers than technology does. And so that's a nice diversification element there, a complementary sector on top of the technology, and that helps to ride out that volatility as well.
Good stuff. Let's talk about some of the big themes that are affecting the markets and sectors. Valerie, you mentioned interest rates. The timing of interest rate cuts are still up for debate. What sectors are going to benefit positively, and then what sectors could benefit or not benefit? they'll be impacted negatively?
I mean, it is the million-dollar question here right now. Everyone, all the portfolio managers, investors are trying to feel out, when are we going to get this inflection point? We've had a very steep tightening cycle. We've seen rates go up quite dramatically, very quickly, and everyone's been waiting for that to kind of trickle down through the economy. Now, it's kind of economics 101, but really the central banks want to see a bit of pain at the ground level. They want to see kind of some job losses, GDP and growth to slow down, giving them the ability to kind of fire off the biggest tool in their toolkit, and that is to begin this rate cutting cycle. Now, rate cutting cycle is stimulatory, right? That's what it should do. As we get in these looser financial conditions, people can go out and spend more and borrow more freely. So can corporations. And you should have this kind of broad-based kind of boost as this cycle kind of feels itself out through the market. But there will be certain winners and probably sectors that underperform in that environment as well. And so the area of the market we would want to look at is cyclical sectors. And this makes intuitive sense, right? These companies within cyclical sectors kind of ride the tide of the economy, right? So they're kind of high when the economy is doing well and maybe ride the tide downwards when the economy is doing poorly. So if we expect to see that change towards a growing economic cycle, then we would want to be invested in cyclical sectors. So kind of what are those? It's consumer discretionary. People can go out and spend. It's financials, it's energy, materials, and industrials. These are kind of your in the ground type companies that will benefit from the most from a growing economy. And then the flip side of that coin is the defensive sectors. So these probably would underperform. So that's consumer staples. If you think about it, we've seen Costco and Walmart do really well recently and through this tightening condition. So they might underperform when things get relaxed.
Chris, another theme that a lot of people are paying attention to are global elections. So we had elections in Russia as well as Taiwan. Now people are focused on India and the US and what unfolds there. How do you think that's going to impact markets?
Yeah, the other big question on people's minds, of course, what's going to happen with this big election coming in the fall? I think one thing that we can think about is obviously it's very hard to predict who will win this election, and in particular in the US, I'm talking specifically. We see many polls that are very close, and so it's hard to predict what the outcome of that's going to be, as well as what the outlook is for the rest of the government as well, and the Senate and the House of Commerce. And so I think one thing we can take away is that regardless of which party wins, likely we're going to see continued inflationary pressures from fiscal policy, whether that's through tariffs, which we're already seeing from the current administration, the new administration, or the prospective Republican as well is talking about a lot of tariffs as well. And so that trend is going to continue, and that's going to keep prices relatively high. As well, Democrats want to continue spending as well, and that could have inflationary impacts also. So it's kind of hard to predict, again, what's going to happen and what the result will be. But I think one thing we could take from elections, if we look in the past, is that they introduce volatility. We're pretty certain that there will be higher volatility this year, as there generally is in election years. And one thing that's interesting this time around is that if you look at the futures market for VIX, the market is already pricing in higher volatility around November. And that's pretty rare for this time of year for the market to already be pricing that in. So really the market participants are already telling us there will be higher volatility this fall. And so I think what investors should do is think about how they want to ride out that volatility, if they're happy to take that on because that is opportunity as well, or if they want to take strategies to maybe reduce that volatility in general. One thing we do tend to see in election years is an increased flow into short-term fixed income. And one thing that we can get this year that we might not have had in past election cycles is a nice yield out of that short-term fixed income. You can get 5+% from ultra short-term ETFs right now. And so that's not a bad place to hide out. If you want to take a little bit of your risk off the table, put it into that short-term fixed income, earn a nice yield on it, and then you have some of dry powder to put back to work depending on what the results are of the election, depending on what your thesis is. You can get that money to work fairly quickly. The other thing investors could do is just look at alternative asset classes or alternative strategies. And I'm thinking about things like gold, for example, very uncorrelated to both fixed income and equities, but could be a source of return for investors. And so gold could be a decent allocation in terms of return potential. And that also helps address the potential inflation concern I was talking about. Regardless of which party wins that election, that inflationary pressure could continue, and gold would be a nice hedge against that.
Valerie, are you seeing geopolitical tensions affect certain sectors more than others? And do you think that'll continue?
Yes, unfortunately, there is a lot going on geopolitically. We've got a number of conflicts, issues like tariffs that Chris brought up as well. So there's a lot for an investor to consider. Fortunately, we haven't seen impact of conflict yet on the US stock market. It's operated relatively agnostically here. Corporate earnings have been growing, and the stock market has followed. But where you have seen the impact of geopolitical tensions is in this commodity space. So we've had crude prices go up almost 20% earlier this year. Gold hit an all-time high. Silver is up even more on a percentage basis. And we've even seen copper rally 20% this year. So these are big moves for the underlying commodity prices. And we have seen the trickle-down effect to the related equities. So that would be the energy sector and the material sector. Now, obviously, these are companies. They have a lot more going on operationally. But net, higher commodity prices should help their bottom line at the end of the day. Another thing to consider, if you think that geopolitical conflict is going to escalate or stay elevated here, is that kind of pressure coming from higher commodity prices. So the one way we back into that is that energy has a very big impact on inflation data. It is a big input into the inflation numbers that central banks look at. So if you expect oil prices to remain higher on the back of maybe escalating or continued geopolitical tensions, that could have wider reaching implications through to central banks' movements and maybe even push out that timeline for the big interest rate cutting cycle that everyone is kind of on tenterhooks trying to pinpoint when exactly we're going to get that. So it's a bit chicken and the egg and a bit far reaching there, but I think it's an important consideration when we talk about what's going on geopolitically right now.
So Chris, for investors who want to use ETFs to gain exposure to certain sectors, as some of the sectors that even Valerie had mentioned, what are some of the considerations? What do they have to look at?
Well, I think first of all, investors should look at their existing portfolio and determine how much exposure they already might have. And I'm thinking, if you have the S&P 500 in your portfolio, you probably have a decent weight to technology already. Or if you have the Canadian Composite, for example, you probably have a lot of financials in your portfolio already. So understanding your current exposure helps you decide that sector trade that you're going to put on. The other thing, I think once you've decided, okay, I'm going to go into X sector and this is how much I'm going to go into, you really want to take a look at the composition of the different ETFs within that sector and what the weighting methodology is of the index or ETF that's tracking that sector. In particular, in Canada, if you're at the sector level, you could get very narrow representation, as few as 10 stocks perhaps in some sectors or even smaller. And so if you're looking at a market cap-based ETF, that could be dominated really by only one or two stocks. Whereas an equal weight ETF will give you exposure, obviously equal exposure, across all of the companies in that sector. So that rounds out the sector exposure a little more better than a very top-heavy market cap-based sector ETF.
Okay, so before I wrap up, I have to ask you both, what is the number one sector to watch in 2024 and why? I'll start with you, Valerie.
So it's a perfect segue. Thanks for teeing it up for me, Chris, but is energy. There is a lot to like about energy. We like it from both a top-down macro analysis and also bottom-up. So our team of research analysts that cover energy stocks specifically, they have said they've kind of never felt more favorable towards the sector in the past decade. They are entering their financially prudent era. And a result of this capital prudence is that they are generating a lot more free cash flow. And that is a boon for investors, right? Because then they can boost shareholder return through this free cash flow generation. So you're seeing that through special dividends, the actual dividend, which the sector is now paying out close to 4%. And again, on just stronger deleveraged balance sheets. So kind of like the financial health of the sector is a lot better as well. And then from a top-down perspective, first of all, Chris mentioned kind of a sector exposure within an index. Energy is very, very small percentage of the S&P 500. It's a little bit larger here in Canada, but again, it's a smaller percentage if you own kind of a benchmark index. So it kind of gives you that toggle there and can actually kind of provide a bit of juice to returns. And then, of course, we have all of the tailwinds that we discussed already. You know, energy tends to do well leading up to a US election. It has a bit of a value tilt. It does well if geopolitical issues worsen, so it provides a bit of insurance there. And valuations are super favorable. They look great on both a relative basis and an absolute basis. Again, it kind of trends towards that value side of the equation. But we think that from both perspectives, there's a lot to like about owning energy here for the balance of 2024.
Okay, so energy's your pick. Yours, Chris?
I'll have to go with financials myself, and particularly I'm looking south of the border. I think financials in general have started to benefit from this higher interest rate environment that we're in. We've also talked already about continued inflationary pressures and potential for interest rates to stay relatively high, even if we do see a few cuts in the near future. But financials do tend to benefit from that higher interest rate environment and the normalizing of the yield curve. We have this inverted yield curve right now where short-term interest rates are higher than long-term interest rates. That's not beneficial for financials, but as we start to see that start to shift, as we get closer to these interest rate cuts, that yield curve will start to normalize, and that will benefit financials, again, particularly south of the border. In the S&P 500, they do not make up a big part of that index. And so if you have that broad US exposure, you're not loaded up on financials already. And so, you know, entering probably a favorable backdrop might make sense to add some financials into the book.
Thanks, Chris. Well, that covers off our discussion today. Thank you so much to Valerie and Chris for sharing their insights. To summarize, amidst notable uncertainties such as the US election outcome, geopolitical issues, and the timing of rate cuts, investors would be wise to stay informed, diversify, and seize upcoming opportunities. Thank you for joining us as we explore the dynamic landscape of this year's key sectors. And a special thank you to ETF Market Insights for bringing us together to host these educational segments for investors. Thanks for watching.